Mr. Pratik Gandotra, partner with Dron Capital. Pratik, good morning. Thank you for joining us. Pratik, let me throw some numbers at you. Indian markets are up 25% this year, and they are up by about 8% in the month of September. So after the recent run-up, how much more do you think the rally will last, and how exactly should investors position their long-term portfolio?
So first of all, it depends upon what your time frame is. If your time frame is a few months, then you might like to wait for a breather, and it might consolidate for a week or so and then resume its uptrend. If your time frame is longer, this is the best time to buy. I mean, the issue is that valuations are still lower than long-term averages. That's also an average kind of valuation. A lot of stocks, if you break down, if you take the consumer stocks out of the equation, then a lot of stocks are quoting at the bottom quartile of their valuation still. So clearly, it's a very good time to buy. I don't think the government is going to relent on its reform momentum, because I don't think they have an option. I mean, this is the best way in which they can restore their credibility within India's business and the constituents abroad as well. And so clearly, the government is not stopping. It's a very good time for investors to buy stocks.
So Pratik, what is it that you're recommending investors to buy from a medium to long-term time frame?
So I think financials are a very good space where one can look at it, because you are I think at the end of the NPL cycle. I mean, that's another assumption that the government will do something about power, and if the power problem is resolved, at least in a manner that the developers make reasonable returns on their investments, the banks can get back their money. At least the concerns around potentially large defaults will recede, and so that's a very, very big positive for banks. Two, also, if the interest rates start getting cut, then there's a rub-off on bond gains, which happens with PSU banks. Three, as even without interest rate cuts, as liquidity is improving, you are seeing wholesale rates coming down already, and the interest rates in the economy starting to trend downwards. So banks which are borrowing wholesale obviously benefit from that, and so do NBFCs. Four, around NBFCs, the regulatory environment is stabilizing, so all the regulatory backlash that has had to happen has already happened. So you have every kind of bad news in the price, and if the economy starts growing with the reform momentum and lower interest rates, then you have the best time to buy banks.
The Motor Dispatch numbers have come out, and the initial numbers are looking quite impressive. If I look at Maruti, at a time when we are making a case that auto industry is going through a cyclical slowdown, Maruti Dispatch numbers for the month of September are rather impressive. And bear in mind that last September or last year or 2011 September, numbers were strong because the Diwali and Dussehra festival season in 2011 were in the month of October. This time around, Dussehra is in October, Diwali is in November, and if still dispatch numbers for the month of September are strong, that just tells you that auto sector per se is not going through a cyclical slowdown. TVS dispatch numbers have also come out, and TVS dispatch numbers are also looking quite impressive. I think I'm slightly confused, because if I map the auto dispatch numbers for the month of August, there is a visible slowdown. But if I map the numbers which I've just read out, especially for Maruti for the month of September, things are looking stable.
Maybe it could be stocking before Diwali. Maybe it could be that. That could be one of the reasons. Also, because the plants would not have been operating at optimal capacity. There would have been some demand, which would have been latent demand. So they would have been trying to fulfill that. So I would not read too much just into Maruti numbers. I would wait for the entire car industry numbers before I would make a conclusion around that. But having said that, see, Nikunj, the issue is that once interest rates start coming off, you look at every last 2-3 cycles which we have seen. The first sector that moves is auto. I mean, the two-wheelers and cars do well the first. I mean, that's where you see the economic recovery going strongly. Second, you will see housing finance disbursements going up. You'll actually see a bit of a fall in housing finance yields, and which I think will have a rub-off on demand. So these two sectors normally obviously lead the rally into the economic growth.
I think. What are your thoughts on consumer staples? Now, we can endlessly talk about valuations, but the bottom line here is that staples is where predictability is strong, spending is strong, growth is back, and cash flow is also quite predictable.
Yeah, so consumer staples, I think, will continue to do well. They are expensive, but it isn't as if their business is under any kind of stress. You'll just see money shifting out of consumer staples into cyclicals, but that does not mean that those stocks will not give absolute returns. But obviously, on a relative basis, they will underperform. I mean, it's just the way the money is going to flow from here on.
I've got a report from IDFC, and IDFC more than I know. IDFC has made a case that it's time to sell ITC.
Sell?
It's time to sell ITC.
ITC. I don't know, maybe that's their view.
What is your view?
No, so I think ITC will do well. I mean, if you're saying, will ITC underperform from here? Maybe it will. Maybe it will. So I would agree with that from an underperformer perspective. Outrightly, will ITC not deliver absolute returns from here over the next 2-3 years? I don't think so.
Pathik, what about some of the commodity stocks like cane or metals like Sterlite, Hindalco or Tisco? Is it time to take a positional trade on any of these names given the China stimulus?
No, so actually I'm kind of still scared on commodities. I don't think the global economy is still out of the woods, and so the money which is coming through into by virtue of QE3 and all the money that the ECB is putting into the European markets, I think that'll more likely than not find its way into emerging market equities rather than commodities. So I am not so bullish on commodities. I would still wait for a confirmation of growth.
Pathik, construct an absolute return portfolio for us. So, I'm going to keep the market cap constraint open. An absolute return portfolio, and the time frame here is 12 to 18 months.
So, okay, I would buy a large private sector bank. So I would maybe buy ICICI Bank. I would buy a mid-cap private bank. So I'd buy either a Yes Bank or an IndusInd Bank. I would buy, I'm just finishing the financials first. I would buy one PSU bank at least. So maybe an OBC would be an appropriate buy. On the infrastructure space, you could look at IRB and say Adani Ports. On the pharma space, one could look at Wockhardt and Aurobindo Pharma. Yeah, I think that this portfolio should give absolute return.
No cement names?
Yeah, fine. Okay, sorry, I forgot. So here I would look at a mid-cap company like the Heidelberg Cement.
Why do you like Heidelberg Cement?
I mean, it's just that valuations are very attractive, and I don't think the implicit understanding between companies has gone away. As you know, I think the overcapacity in the industry is just a mirage. I mean, you will see pricing still being stable, and as volumes improve, as demand improves, volumes will slowly start ramping up, and so you will see stocks doing well.
I think also from next week, markets will move into the earnings groove. So what exactly do you expect to hear from Q2 earnings? Do you expect management commentary to remain subdued, or you expect this time around managements will like to make a commitment that the worst is behind them?
So I would expect confusion. I'd expect confusing kind of messages coming from managements because the economy has not yet turned. So there'd be a set of people who would still be pessimistic. There'd be a set of people who would say their business and who would give a strong business guidance. So this is the most confusing earnings season. You'll get confusing signals coming out from the earnings. So I expect the whole month to be very volatile in terms of trade.
Whereas I like the bullish, Pathik, but is the bullish Pathik also mindful of global concerns? The fact that Indian markets are still dependent on global liquidity, and globally, if the risk on trade reverses, money will move out of emerging markets.
Oh, most definitely. What happens if anything happens in the global risk on trade, if that reverses, then there is a problem. There's a serious problem, because then the rupee will start depreciating again. And that'll be quite disastrous. I mean, disaster in the extent you might see your 5,000 or 4,900 on the index. But I'm saying I don't expect that to happen. And also, it's also a matter of to what extent it reverses. You might see some amount of profit booking and that kind of thing. But if it totally reverses, then there's a big problem.
I think you've told our viewers that how they should be investing from next 12 to 15 months, 12 to 16 months. But how are you personally investing for next 12 to 18 months?
So I'm telling viewers of the sectors which I would invest myself. So I would stay away from consumers. I would put my money into pharma, financials, and a bit of infrastructure. That's what I would do.
You've been hot on JP Associates also. Last time when we interacted with you, you were of the view
that... Yes, that's fine. So, I mean, that's also a good stock. I mean, you're asking me on point blank, it takes time to register it. So, I mean, even JP Associates is a good company. The only thing about JP Associates I'd like to tell you is that I would wait for some kind of asset unlock from them, their debt reduction. So I would like to see some visible signs of debt reduction, because once you see that, then the play is very, very long, and the returns on the stock can be quite amazing. But you have to wait for confirmation that the management is inclined to cutting its debt.